Will today's deal spark some animal spirits among investors and push stocks higher? That is the question. David Bailin is here as Chief Investment Officer at Citi Private Bank. Of course, Jason Trennert sticks with us as well. Do you think this is game-changing? Are we now back into deal mode?
Yeah, well, I think we are back into deal mode. Two of the areas that the private bank really likes for next year are related to private equity and transactions. It's an industry that's going to benefit enormously by low rates. So deals like this are going to make even more sense. They can be acquired, by debt. They can really be earnings accretive. And so next year, I think we're going to see quite an even more active deal market.
So how much of your time are you spending trying to figure out who's going to be the next target?
In terms of building portfolios for that? Yeah, I mean, that's something that the stock analysts do.
And that's sort of a dangerous business.
That's exactly right. But there are industries, and a couple of these that are on here, that really make a lot of sense. I mean, healthcare is one. There's going to be a lot of tech mergers that take place. And those are areas where, even though you can't build portfolios just doing that,
you just mentioned healthcare, and I can see it cutting two ways on healthcare. One is I can see speed up animal spirits, let's get it all done. The other is I could see pencils down, everybody. Elizabeth Warren is coming, and who knows what is about to happen next. And so let's just watch this movie play out and call me in 18 months or 2 years, because I have no idea where this is all going.
Right, and I think that may make it actually a great buying opportunity, and here's why. I mean, we've actually seen candidate Warren, change her structure of what she's thinking about in terms of health care and reimbursements. But more important, this is a global game. And that's why these acquisitions are going to make so much sense. The actual healthcare market in the U.S. is not going to be the ultimate driver. 5 or 10 years from now, you're going to want to own it.
Jason, we talk about animal spirits, and they're here and now. I happen to actually think that some of these transactions that are taking place are sort of what I call like a pre-Thanksgiving, pre-Christmas. If they were in the works before, you sort of have to get them done now because you want to get them done during this calendar year. The question I have is whether you think the animal spirits persist in an election year. Because oftentimes in the corner office around an election, there's this sort of great sense of uncertainty and what's going to happen next. Well, this is true of healthcare, but also true oftentimes of the broader market.
Well, it depends on the types of deals. I think the more strategic deals may take a little bit of a backseat next year, but I do agree with David. I think the financial deals, the financial sponsors, I think private equity has raised far too much money.
Yes, 100%.
And rates are extraordinarily low. They're going to have absolutely no choice, in my opinion, to go for bigger games.
Most of the private equity guys who've come in here over the past 6 months often think that the market is overpriced. They talk about that. They talk about the idea that got to harvest now. No, but we're in the harvesting mode.
The thing I would argue, though, if I can just jump in, is that the public markets are much cheaper than the private markets. And so what I would see next year, what I could see next year is a lot of private equity companies going for public equity targets, using LBOs to take them private.
That's right, and that's one. I mean, we like that area very much. And to your point about the healthcare, if you think about it, take a look at, let's say, like an AbbVie, which raised $30 billion after making the acquisition at extraordinarily low rates. Wouldn't you want to be the acquirer under those circumstances? And you're right, we like private equity for companies that go out and that still have a growth trajectory after they hit the public markets. This is a very good time to be public, given the valuation, the small valuation disconnect.
You made a very smart point just then about this idea that the public markets, relative to the private markets, are at a discount.
Yeah.
The question, though, is really whether the private markets, that those valuations are even accurate to begin with, given what we've seen with the WeWorks and everything else that's sort of coming.
If anything, it would be worse. I mean, if anything, I would argue that, and we've gotten some hate mail on this because we've done some work on it. If you look on a trailing basis, the liquidity, the whole basis for private equity was the idea of a liquidity premium that you had to pay up for a company because it was listed. Right now, there's an illiquidity premium, and whether a lot of fiduciaries want to admit it or not, the opacity of the product actually is the biggest selling point. Because you don't have to market to market, it helps you avoid a lot of embarrassment. Yeah, exactly.
But isn't that a problem?
Oh, I think eventually it'll be a problem. You can fail slowly.
When does this all get written down? And then, but by the way, this is your business. Right. You're putting your clients' money in a lot of these deals.
I think if you're very selective, you're not going to see the write-downs. This whole story that we're going to somehow see a valuation meltdown is not right. I think, for higher quality companies, you're going to want to own them and keep them. And what we want our clients to do right now is to move to dividend stocks and dividend growers, to actually find companies where their payouts are going to be both appreciation and dividends. And there's a lot of companies that you can identify that have a history of doing that.
Your high net worth clients these days, what percentage of their portfolio are you suggesting they get into the private market?
The private market today in aggregate would be 20%. and at least half of that would be in private equity. But it's not the mega funds.
Right.
It's the niche funds that are focused on specific areas like healthcare and like international and distribution.
Why are you making
and
faces
like that?
I'm very skeptical of getting individual investors involved in the private equity market now. I think that would have made a lot more sense 20 years ago, and I know there are people in the private equity business that are running all around Washington to get special exemptions for retail investors. I think it's.
But isn't it moving that direction?
It's a mistake.
Well, I agree with that. I think for ultra high net worth investors, it makes complete sense. I think for my dad, it would not make that much sense, and I agree with that. But I think this whole idea that it's a blanket over, that it's too expensive, I think is a blanket statement is not right.
Okay.